Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Sabrina Aqilah binti Fuad Al-Arifin, number matrix 20214644732. Today I will be presenting about individual assignment 1. The first question is, what is capital structure? Capital structure is the specific mix of debt and equity used to finance a company's asset and operations. Equity capital arises from ownership shares in a company and claim to its future cash flow and profits. Debt comes in the form of bond issues or loans, while equity may come in the form of common stock, preferred stock, or retained earnings. Short-term debt is also considered to be part of the capital structure. From a corporate perspective, equity represents a more expensive permanent source of capital with greater financial flexibility. Financial flexibility allows a company to raise capital on reasonable terms when capital is needed. Conversely, debt represents a cheaper, finite to maturity capital source that legally obligates a company to make promised cash outflows on a fixed schedule with the need to refinance at some future date at an unknown cost. The second question is how to determine optimal capital structure. Debt is an important component in the optimal capital structure. The trade-off theory of capital structure tells us that managers should seek an optimal mix of equity and debt to minimizes the firm's weighted average cost of capital, which in turn maximizes the company value. That optimal capital structure represents a trade-off between the cost effectiveness of borrowing relative to the higher cost of equity and the cost of financial distress. The lower the cost of capital, the greater the present value of firm's future cash flow, discounted by the WACC. To determine optimal capital structure, there are a few steps. The first step is find different capital structure with debt equity ratio. Capital structure is the mixture of capital and debt. For example, we can take 100,000 capital and 0 ringgit debt, or we can take 95,000 capital through shares and 5,000 debt through issues of debenture. Changing the value of share capital and debt value could result in millions of different capital structures. The second step is find the cost of capital and cost of debt at different level of capital structure. The cost of capital is the dividend rate, while the cost of debt is the interest rate on the loan. Both the cost capital and the cost of debt will be low if the risk is low. The third step is find the weighted average cost of capital WACC. The average of the cost of debt and the cost of capital is the average cost of capital. The weighted average cost capital, on the other hand, will provide more appropriate conclusion. So we will construct weighted cost of capital WACC by multiplying the cost of capital by the debt equity ratio. The last step is reach optimal level of capital structure through graph. We can achieve an optimal level of capital structure by displaying the cost of capital, cost of debt, weighted average cost of capital, and debt equity ratio on graph paper. It is the debt equity ratio point at which the weighted average cost of capital is the lowest. The graph paper that follows was obtained from Murray State University's website. In other words, if the weighted average cost of capital is 8%, we can manage our capital structure. The third question is discuss the factor effect capital structure and capital structure decision. The first factor is factors that affecting capital structure. There are a few such as business size, earnings, competition, stage of the life cycle, credit worthiness, risk aptitude of the management, control, state of capital market, taxation policy. Now I will talk about factors in capital structure decision. The first one is capital structure policies and target capital structures. The appropriate combination of debt and equity is achieved by a company's goal capital structure. Thus, assessing a company's cost of equity and the cost of financial distress is challenging. Capital structure policies tend to be debt oriented. Establishing borrowing limitations such as debt as a maximum of X% of total capital. Although capital structure policies are not required by all organizations, they are critical for frequent borrowers due to the danger associated with excessive leverage. Regulators may mandate a capital structure mix in a specific businesses. The second one is market conditions. Managers may close attention to the price of their company's shares and market interest rates on its loans when deciding when, how much, and what type of capital to issue. The risk-free rates plus a risk premium specific to the company equals the debt cost. The risk premium or credit spread is a rate over the risk-free benchmark rate that reflects issue-specific risks as well as broader credit market conditions. More creditworthy businesses with stable and predictable cash flows, reduced risks, and higher debt ratings have lower loan costs. Less profitable businesses, on the other hand, face greater debt costs as a result of higher cash flow volatility and or predictability, higher risk, and lower debt ratings. The third one is asymmetric information and signaling. Managers have more information than outsiders about a company's performance and prospects, including future investment opportunities, resulting in asymmetric information or an unbalanced distribution of information. Debt and equity capital sources demand higher returns from organizations with growing information asymmetry since there is a larger risk of conflict of interest. And lastly is investors' attitude. Varying groups of investors in a segmented market measure risk differently or charge different rates on the capital they invest. Firms decrease their cost of capital by selecting the instrument that accesses the cheapest market. However, there is always a trade-off terms of funding availability. The first question is discuss of financial distress. Financial distress is a term in corporate finance used to indicate a condition when promises to creditors of a company are broken or honored with difficulty. Financial distress is a condition in which a company or individual cannot generate sufficient revenues or income, making it unable to meet or pay its financial obligations. This is generally due to high fixed costs, a large degree of illiquid assets, or revenues sensitive to economic downturns. For individuals, financial distress can arise from poor budgeting, overspending, too high of debt load, lawsuit, or loss of employment. Financial distress can lead to bankruptcy. Financial distress is usually associated with some cost of the company. These are known as cause of financial distress. Sign of financial distress have multiple warning signs, such as struggling to break even suggests a business that cannot sustain itself by generating internal funds and must instead raise capital externally. Other than that, declining sales or poor sales growth indicates that demand is not there for a company's product or services based on its existing business model. When expensive marketing campaigns result in no growth, consumers may no longer be satisfied with their offerings, and the company may be forced to close down. Likewise, if a company offers poor quality products or services, consumers will start buying from competitors, eventually forcing a businesses to close its doors as well. The fifth question is discuss the integration of tax effects and financial costs of distress. A firm's capital structure decisions involve a trade-off between the tax advantage of debt and the cost of financial distress. Thus, there is an optimal amount of debt or any individual firm. This amount becomes the firm's target level of debt. This approach is frequently called the static trade-off theory of capital structure. Capital cost distress is the expense of a financial distress situation in which a corporation is having trouble repaying its debts and liabilities. Indirect costs, conflicts of interest, the bankruptcy costs, and greater capital expenditures are all significant costs linked with financial difficulties. The sixth question is discuss agency cost of equity. Agency cost of equity refers to the conflict of interest that arises between management and shareholders. An agency cost of equity arises when management make decisions that are not in the best interest of the company and that shareholders see as actions that will not raise the value of the shares. For example, management may believe that a merger is the greatest step forward for the company. But shareholders may believe that a merger would not help the company expand and that the money spent on the merger would be better spent on dividends and other investments. The agency cost of equity would be the cost of stopping the merger, such as lobbying. An individual will work harder for a firm if he is one of the owners than if he is one of the hired help. While managers may have motivated to partake in the perquisites, they also need opportunity. Free cash flow provides the opportunity. Besides, the free cash flow hypothesis says that an increase in dividends should benefit the stockholders by reducing the ability of managers to pursue wasteful activities. The seventh question is discuss pecking order theory. According to the pecking order theory, a corporation should seek to finance itself internally first using retained earnings or internal financing, debt financing, and equity financing. If this source of funding is unavailable, a corporation should consider borrowing money. Finally, and as the last resort, a business should fund itself by issuing a new stock. The ranking is significant since it informs the public about the company's performance. When a firm finances itself internally, it is a powerful corporation. If a corporation finances itself with debt, it means management feels confident in the company's ability to make its monthly obligations. This is a diagram for hierarchy for pecking order theory. The first step is internal financing, and then external financing, which is debt. The last one is external financing using equity. So when the risk increases, the cost of finances also increases. The last question is discussing signaling hypothesis. The signaling idea is based on information gaps between shareholders and management. If executives believe their companies are undervalued, they will first issue debt and then equity as the last resort. Management, on the other hand, will issue equity first if they believe their company is overvalued. Rose proposed the signaling theory, which states that if managers have inside information, their capital structure choice will convey that information to the market. The theoretical premise that rises in debt are positive sign that management are optimistic about future earnings may easily influence their leverage. That's all from me. Thank you.